What's up, guys? It's your boy, Quick Stocks. We're back from vacation to educate and, more importantly, help make you some green.
Here comes the money!
As always, remember to hit those thumbs to recharge my dopamine, and we will get right into your quick stock analysis of DraftKings, ticker symbol DKNG, trading for $44.27 a share as of October 18th, 2020, equating to a market cap of $16.7 billion. It's been a crazy ride for DraftKings investors as the company is up over 150% in the last 6 months. However, it hasn't only been highlight reels for DraftKings investors as the company is down over 30% from its highs just in October. So what's the move? Are we going for the Hail Mary and adding DraftKings to our playbook? Or is it time for us to cash out? This is your Quick Stock Analysis. It may come as a surprise to many of you to hear that depending on the day, DraftKings, who has only recently become a publicly traded company through a SPAC last year, now holds a valuation comparable to the combined market cap of the once reigning casino kings MGM Resorts and Wynn, ticker symbol Wynn, for a company that is primarily thought of as a mobile betting broker. Your Quick Stocks reporter must admit it's pretty impressive. And for those of you unfamiliar, DraftKings launched DraftKings Sportsbook in August of 2018, becoming the first legal mobile sports betting operator in the States. The company allows users to enter daily and weekly fantasy sports-related contests and win money based on individual players' performance. Users can make bets in regards to the MLB, the NHL, the NFL, NBA, and the PGA, Premier League, UEFA, NASCAR, Canadian Football League, the XFL, mixed martial arts, tennis, esports, and iGaming. This diversity has proven to be absolutely crucial for DraftKings with the curveball that is 2020. Yes, certainly many of DraftKings' largest revenue sources are being canceled or postponed, but it has also set many of the company's other segments to flourish. Here's a quick clip from Jason Robbins, who is the chief executive and co-founder of DraftKings, from their Q2 2020 earnings call.
Our entry into new jurisdictions and pent-up demand for sports betting as live sports like golf, European soccer, NASCAR, and UFC started to return. To give you a sense of demand, in the absence of major sports, I wanted to provide a couple of highlights. Top NASCAR races, which has traditionally been a niche sport for us, saw similar action to popular NBA regular season games. In golf, prior to this year, our top event of all time was the 2019 US Open. Since the restart of the PGA Tour, 6 PGA Tour events and the Match 2 have topped that major. In both May and June, we more than tripled our previous best month for UFC handle. The momentum we saw in June accelerated with the return of MLB, the NBA, and the NHL in late July and early August.
All of this is extremely bullish for DraftKings investors. However, many bears believe that these inflated viewer numbers have a lot to do with this taking place during peak stay-at-home orders. Of course, with stimulus money making its way through the economy, along with many people being locked at home with little to do, an increase in revenue in these niche markets won't be sustainable once we regain a sense of normalcy. However, on the contrary, many bulls argue this was in fact a gray swan event as the pandemic in fact accelerated the growth of the company's real cash cows, which include iGaming, the company's virtual casinos, which is highly dependent on any given state willingness to allow mobile gaming. And as many states' deficits were accelerated due to the pandemic, meaning laws could be loosened to increase a state's tax revenue. This would be great for DraftKings investors, as it opens an entirely new and much larger market to those who aren't necessarily interested in sports betting, but more so traditional gambling, where people could play cards and slots, except rather than on the casino floor, it's all done online. The advantage DraftKings has over traditional casinos is convenience, much lower overhead, and access to much more data and analytics. Along with iGaming, DraftKings esports segment appears to be a star player in the making. Long term, the company believes esports will be one of the company's largest segments, and that quarantine restrictions have accelerated the segment's growth by many years, which may hold some merit when you consider that
Who's that Pokemon?
younger people are more into esports and video games, TikTok and social media. One could argue that these cultural shifts will have an impact on sports, and it's a great sign when a company is able to change its playbook to fit customer trends. So you gotta be wondering, with huge market share in this rapidly growing market, investors must be wondering, why is this company down over 30% just this month? Well, on October 5th, 2020, the company announced they would be offering 32 million shares of its public common stock, which rubbed many investors the wrong way, as just last quarter the company stated they had $1.2 billion on the books and $0 in debt, leading many investors to wonder why the company chose to change its direction so quickly. Along with this, DraftKings also provided a third quarter 2020 guidance as a part of its stock prospectus. The preview showed revenue mostly in line with analyst consensus, but also revealed that the quarter was probably less profitable than DraftKings had originally expected. Along with this, many large investors are taking money off the table after the company's most recent run-up. No doubt, many eyes are going to be on DraftKings Q3 2020 earnings call, which is expected November 13th, and we actually have some insight as the company released preliminary earnings earlier this month, where the company stated that they are expecting total online sports betting to be up 460% year over year in the quarter, and their casino segments to be up 335% compared to the same quarter in 2019, and a total third quarter revenue of $131 million to $133 million, which would be a 41% increase when compared to the third quarter of 2019, which all sounds amazing, but DraftKings also expects sales and marketing expenses of $200 million to $210 million, which represents a much larger loss this quarter than many investors were expecting. Along with this, the Internal Revenue Services has decided that DraftKings and other daily fantasy sports companies should pay a federal excess tax on daily fantasy sports contests. The tax will apply to entry fees for daily fantasy games, which could add tens of millions of dollars in additional taxes for DraftKings. And more bad news for the company is the NFL continues to report COVID-19 cases. On Thursday, the NFL's Atlanta Falcons announced it's shutting down its facility after a member of their organization tested positive for COVID. If more teams are forced to follow suit, including colleges, it could mean more short-term windfalls for the company. Simply put, many bears argue online betting company stocks are more than fully valued for the best case scenario, which we are certainly not living in 2020. But pump the brakes, fam! It's not all bad news for DraftKings investors. Late last week, the company had reached a full multi-year agreement with Turner Sports, which is part of AT&T Warner Media, giving DraftKings exclusivity as the sportsbook and daily fantasy sports provider for all Turner Sports and Bleacher Report property. And of course, if another stimulus is sent out, which many people are expecting, it certainly means more money will end up flowing to DraftKings. And of course, to no surprise, instead of sports, many people are looking for more excitement and want to bet on the company itself. Last month has brought with it record volume of DraftKings shares being traded, with the bears trying to pull the price down even further with a record short volume of over 100,000 during each of the last 2 trading days. Anyways guys, so with all of this in mind, what's our move? Disclaimer, we are certainly not a financial advisor, i.e. do not sue me, do not buy or sell anything that you saw bought or sold here on Quick Stocks. Anyways, when looking at the graphs, it seems probable that DraftKings will continue its correction into next week. However, take into consideration with many of the large companies reporting earnings and with uncertainty surrounding the second stimulus next week, the market really is anyone's guess. For that reason, any of y'all looking to play the option chain have some serious moxie, and I would have to recommend a credit spread to protect yourself in either direction. However, as someone who believes in the psychology and the impacts that current events have on share prices more so than graphs, as a long-term investor looking to start a position, this could be a great buying opportunity. Here's your Quick Stocks philosophy. Gambling is profitable because humans are irrational creatures who operate on impulse and the desire for that sweet, sweet instant dopamine, which many humans seek out through gambling. And honestly, our culture has been hooked on that instant gratification, and the idea of get-rich-quick schemes are as old as bartering itself. And let's be real, online gambling makes it much easier for people looking for that sweet, sweet dopamine fix. However, in regards to our Quick Stocks, a long-term portfolio, considering the company isn't profitable, and even after the 30% correction this week, the company is still up 345% this year. It's pretty insane considering our current economic outlook. And as y'all know, our Quick Stocks long-term portfolio is already stacked with high-risk growth stocks. For that reason, I won't be picking up any shares unless we see share prices sink to the high 30s, where it has some solid supports, and honestly I would consider holding on to these shares for a decade to come. But anyways guys, that's all we've got for today. As always, the best investment you can make is to go long on Quick Stocks. Subscribe now at 1,800 subscribers and plan an early retirement. I will catch you guys in the next one.